Today we're going to talk about choosing a business structure. So to tell you a little bit about us, BizCentral is a small business resource center, and we offer over 30 business solutions from business plan writing to business certifications, marketing, and incorporation. My name is Mariana, and I'm the marketing coordinator, and I will be hosting this webinar. So today we're going to talk about a couple different things. First, we're going to talk about business organizational structures, forming an organization, legal and tax implications, and advantages and disadvantages of each. All right, so business structure selection. Forming a business or thinking about starting a business can be a very nerve-wracking decision. And it becomes even more difficult when you're thinking about what business structure to choose. So there are two main things that you have to keep in mind when thinking about forming a business. The first is that the business structure you choose will have legal implications, and the second is that the business structure you choose will have tax implications. So let's go ahead and talk about business structures. There are different types of business structures. We have sole proprietorships, limited liability companies, corporations, and partnerships. We're going to start by talking about sole proprietorships. So this is perhaps the most common and simple business type. In this case, you simply decide that you want to start a business, you apply for doing business as a DBA name, and you obtain any business licenses that you need. So a sole proprietor will report the income and expenses and pay taxes through their personal taxes. So basically, you will have an unincorporated business that is run by one individual. And in this case, there's no distinction between the business and the owner. This means that the owner is entitled to all the profits, but it also means that the owner is responsible for all the business's debt, losses, and liabilities. As a sole proprietor, you receive no liability protection. So if an individual or company tries to sue you, they can go after your personal assets. If you have a home, investment, vehicles, lands, or other property, these could all be taken away from you. So let's talk about how you form a sole proprietorship. There's really no formal action that you need to take to form one. This status automatically comes from doing business activities. The only thing you must keep in mind is that you must choose an original name. It cannot be one that is claimed by another business. And if you're using a name different from your own, you have to file for a DBA. This is also known as an assumed name. One thing to do is publish a statement in the local newspaper about the DBA formation, and do keep in mind that you must obtain necessary licenses and permits on local, state, and federal levels if they are required. Sole proprietor taxes. As far as tax implications go, there's some things that you should keep in mind if you're thinking about starting a sole proprietorship. First, in a sole proprietorship, the business and the owner are the same, and for this reason, the business is not taxed separately. In a sole proprietorship, you will report your income or losses and expenses with a Schedule C, Form 1040. The bottom line amount for the schedule transfers to the owner's personal tax return, and the owner is responsible to withhold and pay all income taxes, including Social Security taxes. Now let's talk about the advantages of a sole proprietorship. The first is that it's easy and inexpensive to form. So this is simple. It does not cost much to choose this business structure. The only thing you do need to take care of is getting the required licenses or permits. Another advantage is that you would have complete control. So as the sole owner you can make all the decisions. You do not have to consult with your partner or with other members. Finally, sole proprietorships have easy tax preparation. Because the business is not taxed separately, it is easy to fulfill the tax reporting requirements. And tax rates are the lowest of the business structures. So now that we mentioned the pros, let's talk about the cons. Some disadvantages of a sole proprietorship are that you have unlimited personal liability. This means that there's no legal separation between you and your business. In this case, the owner can be held personally liable for the debts and obligations of the business, and the risk extends to any liabilities incurred as a result of employee actions. The second disadvantage is that it makes it hard to raise money. So there are many challenges when it comes to raising money. Because you can't sell stock in the business, investors won't want to invest. And banks tend to be a little bit more hesitant to lend money because they perceive sole proprietorships as a lack of credibility. So now that we've talked about sole proprietorships, we're going to move on and talk about LLCs. So limited liability companies are a hybrid type of legal structure that provide the limited liability features of a corporation and the tax efficiencies and operational flexibility of a partnership. So when it comes to LLCs, owners are referred to as members. It can be formed by a single individual, two or more individuals, corporations, or even other LLCs. They are not taxed as a business entity, and profit and losses are passed through the business to each member. Members report profit and losses on their personal federal tax returns, just like the owners of a partnership. So how do you form an LLC? Well, the first thing you have to do is choose a business name. So it cannot be the same as any existing LLC. It has to indicate that it is an LLC, including things as LLC or limited company. It can't include words restricted by state, such as bank or insurance. Next, you will file the articles of organization. So these are documents that legitimize the LLC, and they include information like the business name, address, and name of the members. These will be filed with the Secretary of State and Division of Corporations. The third thing to do is create an operating agreement. This structures the LLC's finances and organizations, provides rules and regulations for smooth operation, and usually includes a percentage of interest allocation of profit and losses for the members. The last thing you have to do to form an LLC is to obtain the licenses or permits. So let's talk about the taxes. So when it comes to LLCs, to the IRS, it will not be taxed as a separate entity. Federal income taxes are passed to the members and paid through their personal income tax. LLCs must file as a corporation, partnership, or sole proprietorship tax return, and they must file the specific tax form depending on their classification. So single member LLCs will file the Form 1040, which is the same for the sole proprietor. Partners in an LLC will file the Form 1065, and an LLC designated as a corporation will file the Form 1120. Let's talk about the advantages of an LLC. So first of all, limited liability. Yes, the name indicates it. This is a given. In a limited liability, the members are protected from personal liability for business decisions or actions. So if the LLC incurs in debt or is sued, members' personal assets are usually exempt, similar to the liability protections afforded to shareholders of a corporation. Limited liability, the members are not necessarily shielded from wrongful acts, including those of their employees. Another advantage is less record keeping. So with an LLC, there's a little bit more operational ease, and compared to an S corporation, there's less registration paperwork and less startup costs. Another benefit or advantage of an LLC is sharing of profits. There are fewer restrictions on profit sharing. Members distribute profits as they see fit, and they can contribute to different portions of capital, and they can decide who has earned what percentage of the profits or losses. Some disadvantages of forming an LLC include self-employment taxes. Members are considered self-employed, therefore they must pay self-employment tax contributions toward Medicare and Social Security. Additionally, the entire net income of the LLC is subject to this tax. The third business structure we're going to talk about is corporations. So a corporation is an independent legal entity owned by shareholders. The corporation itself, not the shareholders that own it, is held legally liable for the actions and debts that the business incurs. A corporation is more complex than any other business structure and generally established by larger companies with multiple employees. So let's talk about how you go about forming a corporation. So in order to form a corporation, you must establish a business name and register it with the state. You have to choose, or you can choose to operate under an assumed name or DBA. You have to include a corporate designation, file articles of incorporation with the Secretary of State, establish directors, and issue stock to initial shareholders, register with the IRS and receive a tax ID number, and obtain the necessary licenses and permits at the local, state, and federal levels as required. So let's talk about corporation taxes. So corporations pay federal taxes. Regular corporations are called C corporations, and in some cases they are taxed twice: when the company makes a profit and when dividends are paid to shareholders on their personal tax return. IRS forms 1120 or 1120A are the ones that are used for the corporation tax, and shareholders who are also employees pay income tax on their wages. So let's talk about some advantages of Let's talk about some advantages of forming a corporation. So the first is limited liability. The shareholders' assets are completely protected. The second is that generally the shareholders are only held accountable for their investment in stock of the company. Another advantage is the ability to generate capital. You can raise funds through sale of stock. And corporate tax treatment. Corporations file taxes separately from the owner. Owners pay taxes on corporate profits paid to them in the form of salaries, bonuses, and dividends. Additional profits are awarded as a corporate tax rate. So let's mention the disadvantages of this business structure. First one, time and money. Forming a corporation is costly and time-consuming to start and operate. Incorporating requires startup operating tax and costs. Double taxing is another big disadvantage. When the company makes a profit, you get taxed, and when dividends are paid out, you get taxed. And last but not least, the additional paperwork. Corporations are highly regulated by federal, state, and local agencies. And for this reason, there is an increased paperwork and record keeping involved. An S corporation. So an S corporation is a special type of corporation created through an IRS tax election to avoid double taxation. Once the corporation, to avoid double taxation on the corporation and on the dividends. So let's see. S corporation is different from a C corp because the profit and losses can pass through your personal tax return. The business is not taxed itself, only the shareholders are taxed, and shareholders that work for the company must pay themselves reasonable compensation. So let's see. S corporations are slightly more difficult to obtain than an LLC, and to form one, incorporators must file documents with the state, obtain an EIN, file an S corp election with the IRS, and draft bylaws. An S corporation is considered a pass-through entity, whereby income and expenses pass through the owners instead of being taxed on the corporation's tax return. This avoids the problem of income being taxed at the corporate level and then distributes dividends being taxed on a personal level. S corporations receive the benefit of saving up to 50% of their Social Security Medicare taxes. This is especially beneficial if you do not expect to exceed the income of the Social Security maximum. A drawback of the S corporation is the restriction on stocks and stockholders. S corporations must have less than 75 stockholders and all must be U.S. owned. There can only be one class of stock. This entity type has a board of directors holding annual meetings and keeping meeting minutes. The company will also need to maintain stock certificates, a stock ledger, holding stockholder meetings, and maintain bank accounts separate from personal accounts. So how do you form an S corporation? Well, first, you must charter the business as a corporation. Second, you have to register with the IRS and state and local revenue agencies to obtain your EIN. All shareholders must sign and file a specific form. And additionally, as with the other business structures, you must obtain all necessary licenses and permits on a local, state, and federal level as required. So let's talk about the advantages of an S corporation. The first one is tax savings. Only the wages of the S corp shareholder who is an employee are subject to employment tax. The remaining income is paid to the owner as a distribution. The second advantage is business expenses tax credit. Some expenses that shareholders or employers incur can be written off as a business expense. If such an employee owns 2% or more shares, then benefits like health and life insurance are deemed taxable income. Disadvantages. So they have a more strict operational process. This means that they require scheduled director and shareholder meetings. They have adoption and updates to bylaw, stock transfer, and record maintenance. Another disadvantage is that shareholder compensation requirements. A shareholder must receive reasonable compensation. The IRS takes notice of the shareholder red flags like low salary, high distribution, and that the IRS may reclassify your distribution as wages. So the last business structure we're going to talk about is the partnership. So a partnership is a single business where two or more people share the ownership. Each partner contributes to all aspects of the business, including money, labor, skills, property. And in return, each partner shares the profits and losses of the business. So, additionally, each partner must develop a legal partnership agreement, document how future business decisions will be made. They must discuss how the partners will divide profits, resolve disputes, and change ownership, how to bring new partners in or buy out current partners, and how to dissolve the partnership if necessary. Because partnerships entail more than one people in the decision-making process, it's important to discuss a wide variety of issues up front and develop legal partnership agreements, just to avoid any problems in the future. The agreement should document how future business decisions will be made, including how the partners will divide profits, resolve disputes, and change ownership. So there are three types of partnership: general, limited, and joint. So general partnerships, in a general partnership, you assume that profits, liability, and management duties are divided equally among partners. So if you opt for an unequal distribution, the percentage assigned to each partner must be documented in the agreement. When it comes to limited partnerships, that are also known as partnership with liability, they're a little bit more complex. Limited partnerships allow partners to have limited liability when it comes limited liability as well as limited input when it comes to management decisions. These limits depend on the extent of each partner's investment, and limited partnerships are attractive to investors of short-term projects. Last but not least, we have joint ventures. So a joint venture acts as a general partnership, but only for a limited period of time or for a single project. Partners in a joint venture can be recognized as an ongoing partnership if they continue the venture, but they must file as such. So let's talk about what it takes to form a partnership. So the first step is to register with the state, establish a business name. The legal name is the one given in the partnership agreement or the last name of the partners. You can also register an assumed name, DBA, if you would like, and you must obtain, as with every business structure, the necessary license permits at local, state, and federal level. Let's talk about partnership taxes. So most businesses must register with the IRS and state and local revenue agencies and receive a tax ID number or EIN. A partnership must file an annual information return report to the income, deductions, gains, and losses of the business operation. But the business itself does not pay income tax. Instead, the business passes through any profits or losses to its partners. Partners include the respective share of partnership income or loss on their personal tax return. So, in this case, you register with the IRS, obtain an employer identification number, you file an annual information return, you know that the business itself does not pay taxes, and everything is passed through to the partners. Advantages of forming a partnership. So the number one advantage is that it's easy to form, and most of the time is spent on developing the partnership agreement. So other than that, it goes by pretty easily. Another advantage is the shared financial commitment. So each partner is equally invested in the success of the business and pulling resources to obtain capital. Last but not least, complementary skills. So by having partners, you're able to utilize the strength, resources, and expertise of each one of them. Some disadvantages include: in a joint and individual liability, similar to sole proprietorships, partnerships retain full shared liability amongst the owners. Partners are liable for their own actions and for the business steps and decisions made by other partners, and the personal assets of partners can be used to satisfy the partnership debt. When it comes to disagreement among partners, because there's more than one person making a decision, there is a pretty good chance of disagreements. In this case, they should consult each other on important decisions, make compromises, and resolve disputes. Last but not least, shared profits. Each partner must share the success and the profits of their business with the other partners. An unequal contribution of time, effort, or resources can cause big issues. So in conclusion, choosing a business structure will affect the tax, the legal liability, the financial liability, and your decision-making authority. So when it comes to choosing a legal business structure, professional help can be a good thing. If you do not know or you are unsure about what business structure to use, you can always contact us and we would be happy to help. BizCentral offers a variety of packages and options with flexible payments. We can assist with all type of business formation. We can expedite the process and ensure that it's accurately assembled. So as far as our incorporation services go, we offer two different packages. The basic incorporation package, which includes the document prep for incorporation or LLC, the tax ID, and the bylaws for $149. And then we have the package plus, which includes all the items mentioned previously, and a corporate book and book content samples. So if you have any questions, please feel free to email marketing@bizcentral.com, or if you have specific questions for me, I can be reached at extension 522 or mdavila@BizCentral USA. For those of you who are wondering if the recordings of this webinar are going to be available, the answer is yes. You will be able to find them at bizcentral.com bizcentralusa.com/webinars. So I hope you learned something today and you enjoyed it. Please stay tuned for next webinars. Our upcoming one is on creating websites. I hope you guys have a great day and thank you.